Okay, hello sir. We are from group number 5. We talk about depreciation. Okay, my name is Ngumbang. Before we start the presentation, I would like to introduce my member group. Okay, first we have Ahmad Zakwan. Second, we have Dominic Mantan. And third, we have Afiado Puhu Lembetus. And last we have Mirza Shahiran. Okay, what is depreciation? The depreciation is an accounting concept through which business calculate the declining value of their asset over time. Depreciation also means a fall in the value of asset with time to use or obsolescence. It is regarded as a non-cash transaction and does not represent real cash flow. Okay, depreciation also is a method of accounting which is used by a business to calculate and allocate the declining cost of its tangible asset over their useful life. Okay, these assets are including building, machinery, equipment, and so on lah. Okay, purchased by a business in the say financial years. It is basically is a non cash transaction which entail the decline in an asset value with the passage of times. Long long term assets are depreciated by a business for accounting and taxing purpose. Depreciation is recorded as a expense and deduction from fixed asset whenever a business prepare its financial statement. Okay, the serve of purpose spreading in initial price of the asset over its useful life. Okay, the way is which uh, business use depreciation can have impact of on the view of a short-term investment opportunity. Although depreciation is to be expensive according to a set of rule. The management of business can manipulate it to mislead investor and analysts. Therefore, they are evaluating financial statement. It is important to be aware of various misleading assumption and method used by business. Okay, these are for introduction, sir. So I would like to pass on the next slide, my friend. Okay, thank you.
Okay, next slide, Afi.
Okay. Uh, okay. I want to explain about the straight line. Straight line is first is use the straight line dispersion method. Find the total cost of the asset. Okay. Total cost is cost plus shipping plus installation. And its main is TC. And the second is find the depreciation value. Depreciation value is DV, TC minus salvage value SV. Find the year's depreciation. Okay, year's depreciation is equal depreciation value divided year of expectation life. Okay, next slide. Okay, look at this example. Use the straight line method to find the yearly depreciation for a planing machine that has expected useful life of 5 years. The planting machine costs 27,300. Its shipping cost total 250. Installation charge come to 450, and its salvage value is 1,000. Okay, you must find the TC first. TC is firstly you must find the TC, and the cost. The cost is 2,000 27,300 plus the shipping cost to 250 plus the installation charge 450 equals is 28,000. Okay, and the second is depreciation value DV. uh, TC, that the total of the TC, and you must at 28,000 minus the salvage value and 1,000 equals 27,000. And the last is yearly depreciation. After the equal of the depreciation, at the answer depreciation value, you track the depreciation value to the yearly depreciation 27,000 divided 5 years equals 5,400. That's the yearly depreciation. Okay, next slide. Okay, this is the same that the first example. Okay, a labeling machine costs for 43,000. Installation cost total 1,250 and the shipping cost total 2,250. It has an expected useful life of 5 years. Its salvage value is 2,000. Use the straight line method of depreciation to find the yearly depreciation for the labeling machine. Okay, first you must found search the TC. Okay, the labeling machine cost is for 43,000 plus the shipping 2,250 plus the installation cost 1,250 equals 46,500. Okay, next you must find the expression value DV. TC cost 4,650 minus the salvage value 2,000 equals 44,500 DV. After that, find the yearly depreciation is the DV divided 10 years. Okay. The DV is for 44,500 divided 10 years equals 4 4,450 per year. Okay, next slide. Okay, the key terms depreciation variation secures a table shows the year's depreciation, the accumulate depreciations, and the year of the yearbook's value. Accumulate depreciations, the current year's depreciation plus all the previous year's depreciation. End of the book value total, meaning total cost minus depreciation of the year of the first year. There is the previous year end of the year book value minus the current year depreciation. Okay, next slide.
Okay, thank you, Alfredo, for your explanation about straight line there. Okay, next topic is use the unit of production methods. Firstly, the unit of production methods for the depreciation is based on the asset user activity or part of produce instead of the passenger for time. Other unit of production method is depreciation during a gift year we very high when many units are produced and we be very low when only a few units are produced. This take into the account asset used in the term for production. For example, like the item produced. Second, a miller's drive. Third is how operate, and lastly, number of time is has performed a specific operation. Okay, next slide. Okay, to find the unit depreciation is we have two formula. First formula is unit depreciation is the depreciation value divided by unit produced during its paid life. This formula is we must use the DV divide by S per unit. Okay. Second formula is depreciation of the unit produced. Is unit depreciation multiplied by unit produced. Second slide. This for example from the unit production. A level making machine that costs 28,000. Uh, to resolve the problem solution, we use the formula. Firstly, depreciation value equal to total cost minus service value is 20 28,000 minus 1,000 equal to 20,000. And second is unit for depreciation equal to depreciation value divide by produced during its paid life. Second is unit or production equal to 27,000 divide 50 million is F 0.0054. Okay, first depreciation of 2,125,000 label equal to 0.0054 multiplied by 2,155,100 equal to 1,147.50. Okay, second example. Okay, second example, we same use the formula that depreciation value equal to total cost minus service value. Okay, firstly, we will to find how to find this solution. We must firstly we must minus 24,000 minus 1,500. Total is 21,500. Second is unit depreciation. We use the second formula is depreciation value divided by produced during its paid life. Is same to 21,500 divided by 100,000. Total is 0.250. Is second is depreciation for 3,000 label equal to 0.15 multiplied by 3,000. Total is 645. Okay.
Okay, thank you, Dominic. Okay, now I want to explain about use the sum of the years digit method. Okay, sum of the years digit method, a depreciation method which allow the greatest depreciation the first year and decreasing amount each year thereafter. Year's depreciation rate. The depreciation rate for any given year of a depreciation schedule. Next. Okay. Find the year's depreciation. The numerator of the year's depreciation rate is the number of the years of expected life remaining. and the denominator of the years is depreciation rate is the sum of the number from 1 to the years of expected life. Shortcut for finding the sum. The shortcut is n divided by n plus 1, n bracket n plus 1 divided by 2. Okay, so the numerator. Okay, this is the example. Find the depreciation for each of the 5 years of expected life of bottle capping machine that cost 27,300,000 and has a shipping cost of $250 and an installation cost is $450 and a salvage value of is 1,000. Make a depreciation schedule. Okay, so as we know, the denominator is n times n plus 1 divided by 2. Okay, so what is n is referring to? So the n is based on the years that in the question. So in the question that show the n is 5 years. So 5 times 5 plus 1 divided by 2 equal 15. Okay, the numerator. Numerator is for year 1 is I explain first about the numerator. The numerator of the year's depreciation rate is the number of years of expected life remaining. Okay, so refer to the question for the year 1, it's remaining equal 5 year, and for the year 2 is remaining for 4 years, and so on, like year 2, 3 and 2, 3, 3, 4 and 5. So this is the example, the table of number of remaining years of expected life. So for the year first equal to remaining 4 years, second years is remaining to 3 years, and so on. Okay, how to find depreciable value? How to find it? Total cost is minus by salvage value. As we know, the total cost is the sum of the cost, shipping cost, and installation cost, and then divide by salvage value as given at the question. So the total cost is 28,000 minus by 1,000 equals to 27,000. Depreciation schedule. For year 1, the depreciation value is 27,000 times by 5. The 5 is remaining prefer to the years, the denominator divide by 15 equals to 9,000, and then the end of year book value is 28,000 minus by 9,000. 28,000 is the total cost, minus by 9,000 equals to 19,000. Okay, after that we look at the second year. The second year, 27,000 is times by 4. That means 4 is prefer to remaining of the years. Divide by 15. It's equal to 7,200. At the end of the book value, we get a new TC, which is we get the remaining of the cost based on the last year, which is 19,000, and then we minus it to accumulated depreciation. The accumulated depreciation is the 7,200. So we can get the answer is 11,800. So now calculate the depreciation schedules. This is the table. We can see that how the formula uh, is getting until the last year. We can get 1,000 remaining. Okay.
Okay, hi, and good morning, good afternoon. Okay, I'm Azakwan. So will be explaining the declining balance method of this depreciation. A depreciation method that provide for large depreciation in the early years of the life of an asset. Okay, so for the double declining rate or 200% declining balance method is it is a declining balance depreciation that is twice the straight line depreciation, which is for the straight line depreciation is will be 100%, but for the twice the straight line depreciation it will be cost for 200% declining balance. So there will be also 150% of declining rate as a common declining balance rate that is 1/2 times the straight line rate. Okay, I will be continue. Okay, for the yearly double declining rate is equal yearly straight line. For this to find the depreciation, okay, as to find the yearly double declining rate, yearly straight line depreciation rate times by 2. Okay, for year 150% declining depreciation rate, yearly straight line depreciation rate will be times by 1.5. Okay, as 150 for the percentage will be convert to decimal. Okay, to find the first year depreciation, total cost times the rate, and for all other years, the year's depreciation is the equal to previous and of year book value times yearly depreciation rate. So, which is the remaining of the annual book value will be timed by the yearly depreciation rate. Yes, this is have some example. Okay, as an ice cream freezer has a useful life of 6 years. Okay, it state here it is 6 years. So to find the yearly straight line rate expressed as a decimal and a percent, double declining rate expressed as a decimal and a percent, and 150% declining rate expressed as a decimal and a percent. So this is the three of the answer that we this is three of the question that we must find for the answer. Straight line, it will be 1/6 or 0.1667 or 16.67%. Okay, which is 1 is equal to 100% that has been converted to 1, and 6 is the years. Okay, for double declining that that we have been see for the to find double declining rate, yearly straight line depreciation rate times 2. So that is the formula to find the double declining rate. We must 2 times by 1/6 equal to, the answer is 1/3 or 33% or 0.33 after convert the percentage into the decimal. Okay, and for the 150% declining rate, the formula is 1.5 times by the yearly straight depreciation Where there is the straight line 1/6 equal to 1/4 or 0.25 for the decimal or 25%. Okay, we continue. Okay, so this is some of the tip that we need to look up. In declining balance depreciation, the depreciation for the first years is based on the total cost of the asset. Okay, this is important that do not subtract the salvage value from the total cost to find the depreciation in the first year. Because the end of year book value for any year cannot drop below the salvage value of the asset. If the depreciation would cause it to drop below the salvage value, the year's ending value will be the salvage value. Okay, this is another of example. Okay, a packaging machine that is costing about 28,000 with an expected life of 5 years. So here as stated the 5 years and a resale value of 1,000 is depreciated by the declining balance method at twice the straight line rate. So this is what we have see. This is 1,000 service value. So but we can subtract the TC total cost 28,000 by the 1,000 because we must find the 1,000 by the twice of the straight line rate. So try to prepare a distribution schedule which is year 1. Okay, this is how to find the distribution rate for the twice straight line rate. Okay, year 1 2 times by 1/5 because of the 5 years and 1 is equal to the straight line of 100% equal to 2/5 or 40% or 0.4 as the decimal. So to find the distribution, 28,000 times by the yearly straight, the twice the straight line rate is 0.4 equal to 11,200. So to find the end of year 1 book value is total cost minus by the depreciation of the sorry, minus the depreciation. Okay, so end of year 1 the total cost is the 28,000 here as stated the 28,000 minus the 11 the depreciation which is we get 11,200 equal to 16 16,800 which is the new uh is not a call a new TC but it is the previous end of year 1. So sorry is the remaining of the total cost. Okay, so to finish up the differential schedule which is for the year 2 we the previous end of year book value that we get 16,800 will be times by the 0.4 equal to 6,720 for the new the double declining rate the twice of the remaining for year 2 to find the year 2. So end of year 2 book value will be previous end of year book value minus the depreciation. So depreciation is 6,720 and for the previous end of year book value is 16,800. So 16,800 will be minus 6,720 and the amount will be left is 10,080. Okay, so we go to the next slide for the year 3, 4 and 5. Okay, this is the method for the remaining years. Okay, so the year 3 previous end of year book value times the double clean declining rate, which is 10,080 times by 0.4, the declining rate. 4,003, it will be going to be 4,032. So for the end of year 3, the book value is which is we say the previous end of year book value will be minus 4,032 and get the new end of year book value. Okay, so for the year 4, it's same as the method of 3 of the year 3 and the previous years, which is 6,048 by times by 0.4 to get the depreciation value. So 6,048 will be minus 2,419.20, which is the depreciation equal to 3,628 and 80. So for the year 5 depreciation, as the same method, the previous end of year times by the 0.4 declining rate, which is 1,451 and 52. So for the last end of year 5 book value will be going 3,628.80 will be minus 1,451 and 52, and the answer will be 2,177 and 28. Okay, so this is my explanation for the depreciation declining rate. Okay, this will be continued by Gumang.
Hello, sir. We meet again. I will like present about depreciation method for using IRS reporting. Okay, the depreciated an asset and prepaid depreciation schedule use the modified accelerated cost recovery system is called MACRS. Must maybe is depreciated an asset after taking section 179. Okay, how do you we use using MACRS? In 1981, the IRS enacted an accelerated cost recovery system. It's called ACRS. Okay, for the depreciation of property put into service after that allowed allowed allow businesses to write off cost of asset more quickly. Objectives was to encourage business to invest in more asset despite an economy slowdown at the time. Okay, would like to talk about the table of here we have the table 16 until 5 indicated that each recovery report a period has a depreciation rate for 1 year more than the recovery period indicated. Okay, first and last year in the recovery period partial years, greatest amount of depreciation is realized in second years, which is the first and full years. Okay, here we have using the MACRS method. Okay, using the IS publication, determine the asset recovery period and find the appropriate table. Okay, we have find the MACRS rate using tab like I said that later table 6 5. Okay, multiply the year MACRS rate by the total cost of the asset. Okay, this year depreciation year MACRS rate divide by total cost. Okay. Okay, here we have examples. Find like you can see, find the depreciation for each year for a boiler that was purchased by $28,000 and placed in service at a mid-year under the MACRS. method of depreciation as a 5-year property. Okay, we have 1 year depreciation divided by a total cost. Year 1 depreciation 20% divided by $28,000, and when here we have the answer is $5,600. Do the subsequent year through 6 year. Okay, here about example for the calculation, like you can see there, sir. Okay, I would like to talk about depreciated and asset after taking section 17X deduction. Okay, for tax purpose, it can be treated as a one-time expense rather than as a capital expenditure that is depreciated over several years. The amount that is claimed under section 179 is subtracted from the original price of the property, and the balance can be depreciated using any of the approved method of depreciation, eligible only in the year that qualifying property is purchased and placed into service. Okay, here we talk about next we have section 179 deduction. Okay, property must be placed in service for business purpose only. A property put in service first for personal use and subsequently for business use will not be eligible. Eligible property in general is tangible, depreciable personal property that is used for the production of income. Okay, can be only be used to reduce taxable income, not to create a net loss. Estate and trust cannot claim the section 179 deduction. Okay, how to depreciate an asset after taking a section 179 deduction. Okay, I would like to say this talk about 17 section, whatever, section 179 deduction. Okay. Decide how much of the maximum section 179 allowance to apply to the asset. Okay, subtract the elected section 179 deduction from the total cost of the asset. Okay, apply an approved depreciation method to the value from the previous step. Okay, instead of the actual total cost. Okay, here we have an example for you, sir. As you can see, okay, that's also thank you from us. Thank you for our group and thank you for hard working, sir. Thank you so much. Thank you. Goodbye.